Welcome to the Achievable FINRA and Insurance Podcast. I'm Tyler, founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, 7, 9, 63, 65, and 66 exams, as well as the Insurance, Life and Health, Property and Casualty, and Personal Lines exams. We have a 95% or better pass rate across tens of thousands of students for all of our courses. And each Achievable course includes everything you need to pass the first time: a full textbook, videos on key topics, thousands of questions backed by our memory enhancing algorithm, and many full length practice exams to ensure that you're ready. You can try any of our courses out for free by going to achievable.me, and if you like it, use the code podcast to get 10% off at checkout. Now, let's get started. Today we've got Tony Steuer with us, and Tony, I'd love if you could introduce yourself.
Yes, so I am an author, podcaster, and financial preparedness advocate. I was in the life insurance field for about 30 to 35 years. I've spent time starting out as an agent to becoming a fee-based insurance consultant, and now predominantly spending my time education, financial literacy work.
Great. Yeah, so let's get started. Today we're going to be going over the basics of life insurance, and I think to start things out, I feel like that this is really it's targeted towards either prospective or current agents, so it's more of the business side of life insurance on the consumer side. But let's talk about just like the basic concepts, right? I mean, obviously we all know it's very important, right? It helps insure your family in the event of your injury or death. But what are like the types of policies? Let's start with that.
Well, I think the basic thing that we need to remember in the industry is that these are all life insurance policies. And no matter what type of policy you're looking at, it's still a life insurance policy. So when you open up, and we'll go through the various types of insurance, it always says this is an insurance contract, because sometimes as you go through some of these policies, it gets confusing. They have cash value components, they may be tracked to a variable sub account, but it always comes back to the fact that these are life insurance policies. So you have two basic categories of life insurance policies. You have what are called term life insurance policies, which have its own subtypes, but those are policies that provide no cash value and generally last for a specific number of years. You may have level premium term, which is guaranteed for a specific number of years, or annual renewable term, where the premiums go up every year. And those are
Mhm.
usually for a set period. Then you have cash value life insurance, also called permanent life insurance. Although personally, I would stay away from the name permanent life insurance because those policies do also have a maximum age. And depending on a policy, that maximum age can be anywhere from 90 to 120. So 120 is probably permanent for most of us. And then you have subtypes under that. You have whole life insurance, you have universal life insurance, you have variable life insurance, you have variable universal life insurance, and then you have equity index universal life. So there's a whole variety of subtypes of all these different types of insurance.
Mhm. Yeah, and I think, as an agent, right, how are you typically approaching these? And is it that early in your career you're only really selling certain types, or does it just depend on where you work, or do you get to choose? How does that all work?
Well, sometimes it may depend upon the companies that you're contracted with. So if you're coming in as a career agent and you're working for, let's say, one of the bigger life insurance companies, and that's with the company's products you're obligated to sell, well, then you may not have a full choice of products. So you may have to sell those products. But if you're coming in and you're working for, let's say, a brokerage where you have the choice of products to sell, then you can really be thinking about first, like, okay, what is my client trying to achieve? And that's been a huge challenge in the life insurance industry, is the thinking has always been, let's go out and sell this type of product, or let's go out and sell that type of product. Where instead, if you want to have a long and successful career in the life insurance industry, you really have to think about, okay, what is my client trying to achieve? And then you find the right product for them. It's just like, if you're doing any type of job around the house, you want to find the right tool. So you don't start off with a hammer and saying, okay, well, what problems can I solve for this hammer? Instead, you're like, okay, well, I have this problem and the hammer is going to be the right solution. So that's where I would say is that you always want to start thinking about what is my client wanting to achieve and how can I help them best achieve it?
Yeah, and so I mean, I'd love to dig into that, but before we get there, I think we should understand what the different types of life insurance are for, right? So maybe starting with like term life insurance. What is sort of the suitability of term life insurance, or what are the things that term life insurance is best for?
Well, term life insurance is for covering a certain period of years, hence the name term. So generally, it would be something, and most people only have a need for term life insurance. So you're going to hear all kinds of different things as an agent as you go through it. But most of us are buying insurance to, let's say, cover a mortgage, to provide coverage until our kids reach the age of maturity, which these days it might be 50, but generally, we're hoping that our kids are self-sufficient by the time they're 20 or 25. So you have a temporary need. The other thing is people will say, well, if you're getting it for your spouse, you need it forever. Well, not necessarily, because hopefully by the time you and your partner retire, you're going to have enough other assets accumulated that could offset the need for life insurance. So again, that's where you're thinking about like, okay, what is my client trying to achieve? And so term life insurance is going to be the lowest premium form of life insurance because it's providing death benefit only. It's providing pure insurance, where the permanent life insurance policies have a cash value component which you are going to pay for.
Yeah, and I mean, the other thing is that you can borrow against that cash value component, which could potentially, I don't know. I mean, is that something that's typical that people do? It feels like, okay, so you pay a bunch of money to have a really big cash component of your whole life insurance, but then you also borrow against it. Is that a winning formula? I don't know how the math works out there.
Well, policy loans gets into its whole thing, but this is a really good
Yeah.
topic for people coming in as new agents is because you're taught that whole life insurance or some marketing schemes out there, and that's the whole thing. It's like sell whole life insurance to everybody you know. It's this great Swiss Army knife of financial planning, but it's not because, as you point out, you can take a policy loan, but there's going to be ramifications because insurance companies aren't in business to lose money. So the common argument you may hear, and you'll see this on YouTube, is like, oh, well, you're just borrowing money from yourself. No, when your client borrows money from a life insurance policy, they are borrowing money from the insurance company. They are taking out a portion
Mhm.
of their cash value. So on a whole life insurance policy, the cash value is not a separate account. It is a reserve account on a policy. And so that's a really important distinction to understand with the structure of the policies. So you're taking some of that reserve amount out of your policy. So when you do, the insurance company says, well, we don't have that money to invest for ourselves because the insurance company is thinking the client's going to have, let's say, $10,000 worth of cash value. And so the insurance company is saying, okay, well, we're going to be able to invest that $10,000 and earn $10 of interest this year. However, if your client takes out that $10,000, the insurance company cannot invest that. So they lose out on that $10 of interest. So, who, of
Mhm.
course, are they going to charge for that? They're going to charge your client for it because they need to still make that $10. Because again, insurance companies are in business to make a profit and they have to be able to pay the claims to your clients. So the insurance companies have to remain profitable. So a policy loan can become a double-edged sword, and we can go way deeper into that if you would like, Tyler.
I think that was a good summary. I'd love to also just talk about the other types like universal and variable life and who are they best suited for?
That's an excellent question, and that's where it gets into having conversations with your client and trying to find out what are they really trying to accomplish? How comfortable are they with different financial products? So whole life insurance is the oldest form of life insurance, period. And it provides a fixed guaranteed rate of return, and in some whole life insurance policies also pay a dividend. It's usually the most expensive type of life insurance, but that's because everything is guaranteed. Your client gets a guaranteed premium, there's a guaranteed death benefit, there's a guaranteed cash value. Everything is guaranteed. Now you can get some extra dividends on the policies. The cash values may grow because of the dividends, but you're talking about starting off with everything being basically guaranteed. Then the next type of policy is universal life insurance. And I'm also doing this somewhat in order of the way the products were rolled out by the industry. So the universal life policies, the idea was, well, clients wanted some flexibility. So the technical name for universal life is flexible premium adjustable life insurance. And what that means is that you can adjust the premium that you pay on a policy. So with whole life insurance, because it's a guaranteed premium, you have to pay that premium in whole when due. With universal life, you could pay a lower premium if you want, or a higher premium. So, without getting into the problems of missing premium payments, because of course then the insurance company doesn't have the money it's expecting, is your client does have some flexibility. So universal life does provide some flexibility. The higher the premium the client pays, the higher the cash value will be. The lower the premium the client pays, the lower the cash value will be. However, something to keep in mind, and we can get into how this impacts the structure of the policy. If the client pays too little into the policy is going to crash at some point without value well before expected. So that's why when you start leaving whole life insurance, you have to start thinking about which guarantees the policies feature. Now, there's a newer type of universal life insurance that you'll encounter, and it's called guaranteed universal life insurance. And what that policy does is that the client pays a guaranteed premium. And if they pay that guaranteed premium, then the death benefit becomes guaranteed. So even if the cash value, if they don't grow a cash value, the policy still stays in force. Where with the prior example, if the client misses a premium payment, the universal life policy is going to lapse. In this case, there are no lapse guarantees. And I know I'm throwing a lot out there at the people who are watching and listening. So you can go back and look over this. I'm sure this is in the courses, Tyler. People can take a look at this, but this gives you an idea. Then we get into the products that have some kind of equities relation or securities relation. So we have variable life insurance, which is a form of whole life insurance. We have variable universal life insurance, which tracks universal life insurance. But the difference there is on whole life insurance, the company is declaring an interest rate based upon their returns, and it's guaranteed. With variable life, it's based upon subaccounts that the policyholder chooses. Your policyholder will get a selection of subaccounts that they can invest their money in. Now, with variable universal life, is they can adjust the premium. It can adjust the subaccount where their money is invested in. They can adjust the death benefit. So it starts to get more complex. Another thing to keep about variable products is that you'll need a securities license as well as your life and health license to be able to sell those variable products. So the insurance industry came out with a solution to that because the insurance industry always has a solution to these things. And they developed what's called equity indexed universal life insurance, or it's also sometimes referred to simply as index universal life insurance, but it's the same thing. So instead of investing in mutual fund subaccounts, the cash value is invested in indexed accounts, which tracks indexes like the S&P 500, the NASDAQ, it tracks the different indexes. So that's kind of the differences. And then it goes way down more than that. The other thing about equity index universal life policies is that you have to keep in mind that they have other components that you need to be familiar with before you start selling those policies.
Yeah, I mean, certainly you're going to need your securities license, right, for those policies. But I think what I'd love to talk about now is kind of like why someone would do that, right? Life insurance to me, as sort of a consumer, feels like a pretty straightforward transaction. I pay you money kind of until I die, and in return, we get a large chunk of money back when I die. What kind of person would want that indexed or just variable insurance and want it to be tracking the S&P 500? And kind of what are the mechanics of it?
That's a great question. Personally, I believe that most people just need term life insurance and that's all they need. I am not a believer in indexed universal life insurance. So, for people watching and listening, you can make your own judgment and assessment on those products. The reason why some people buy a permanent life insurance policy is because they have a permanent need. Let's say they have a special needs child, or they have a divorced spouse that they need to take care of for the rest of their life. So they have some type of lifetime obligation. They may have an estate planning issue. So then they're looking at a permanent life insurance. So then the question becomes, what is the best type of permanent life insurance? Now, the reason why a lot of these cash value policies are sold is as alternatives to other investments. But that's where I would urge newer agents is to really get familiar as to whether they're really good investment alternatives for your clients, because hopefully you're developing a long-term relationship with your clients, which is what's going to help you be really successful in the business. Now, the mechanics. So as I mentioned, we won't really talk about variable and variable universal life because if you get your securities license, you're going to go through a lot of education on that. So we probably shouldn't spend a lot of time on that. Is indexed universal life. What happens is you're investing in these indexes, but the company controls a lot of the factors on a policy. There's what's called a participation cap, or so let's say the index earns 15%. The company has a participation cap of 12%. That means your client only earns 12%. Now, the company is going to come back and say their justification for offsetting that is that your client can't have a negative return rate, which is definitely a positive. So, but it is capped. So if the S&P 500, and we're just assuming the cash value is invested 100% in the S&P 500, earns 25% 1 year, which is definitely not unheard of, you're still capped at that 12%. So you lose a lot the upside for the trade-off of not having downside. Now, the other thing is that the company can change how much that you participate in. So they may say you have an 80% participation rate. So you only get 80% of that 12% is what the value is that you're getting in a policy. So the policies start getting very complex. So as a new agent, is that something to keep in mind? If you're sitting there and you're not really able to understand the policies, you have to think about it. If I'm not really understanding it, is this the right policy for me to be selling or to talk to my clients about? Now, as you go through and as you learn, as we all do once we start in a new career, is you'll learn how the policy works, and then you'll have a better sense of like, okay, this is how the policy works so I can set it up well for my client and help my client monitor it. The way those policies, the only scenarios where those policies can work well, and I'm not a big believer in them, but where they can work well is when clients are putting more money into them than is required. So when clients are putting in the minimum, they really don't work well because remember, at the start, they're an insurance policy. So the first thing the insurance company is going to do is they're going to take out the cost of insurance. They take out the cost of insurance, and then with whatever value is left over is where they credit the index return rate. So you have to keep that in mind is that they're always insurance policies at the end of the day. So when you're comparing them to an investment, they're not an investment because they're still an insurance policy and your clients will always be paying for the insurance.
Yeah. So then let's talk about just the mechanics of life insurance and kind of how it works, right? So, roughly speaking, you're going to pay premiums to this company. Some of those premiums may or may not go into an indexed fund, depending on what type of life insurance it is. But then the insurance is basically signing up for an obligation to eventually pay you out after you die. And so I guess, is there anything beyond that pretty simple explanation that you want to cover? And then after that, how do we underwrite people? What is sort of the idea that affects what your rates are going to be and sort of how the insurance company evaluates this?
Definitely. So the first thing I would urge people to be familiar with are insurance company financial strength ratings. So even if you're talking about a term life insurance policy, you're still talking about a policy that's going to be enforced for 10 to 30 years. So it's very important to make sure that you're selling insurance with companies that are going to be around to pay a claim. And that's why most life insurance companies are really old. When you look at some of these companies, you'll see they've been around for 100 years, 150 years, is because these are very long-term obligations. And if you get into a whole life insurance policy, your clients may have that whole life insurance policy for 70 or 80 years. So you're talking that it's really important to make sure that it's a financially stable company for your client. And then you want to think about like, okay, with a term policy, it's pretty simple. Is you pay a premium, that's the amount of money that's being paid. If you pass away, if your client passes away, they get the death benefit. Pretty simple. The insurance companies will also, so they're charging you for the insurance, plus there's a small overhead fee, for each year that the company charges on the policies. Now, when you get into a whole life insurance policy, as I mentioned earlier, it's all guaranteed. The insurance company says you want $100,000 of life insurance. This is the premium your client's going to pay. This is their guaranteed cash value. If it's a participating whole life insurance policy, your client may also receive a dividend. So that's something else. So when you're looking at whole life insurance policies, there's two types of whole life insurance policies. Well, two basic types. We can keep going down these rabbit holes. There's participating, which means your policy owner may receive a dividend, and then there's non-participating where your client won't receive a dividend. Now, there can be pluses and minuses to both, but that's something to keep in mind. So that dividend is declared by the insurance company based upon their returns, but it's a black box. The insurance company is going to say, well, we had a 5% rate of return on our investments this year, so we're going to credit all our policy owners 4%. Doesn't work like that. The insurance company will just say at the end of the year, we're paying 5%. Boom. And that's all the information you get on a whole life insurance policy. But if you look at some of these companies that have been around for 60 or 70 years, you can take a look at their dividend paying history to get a sense of what they do. And, and you can get a sense of the economy and everything else. Because remember, insurance companies, they're taking this money that they're not paying out in claims and they're investing it. So insurance companies, when they invest, they have to invest for the most part in very risk-free assets for themselves. So they're investing the majority of their money in bonds, treasury securities, and similar things. So they cannot take a lot of risk. So an insurance company can't turn around and take a policyholder's money and invest it all in Bitcoin. They are restricted in
Yes.
what they can invest in. So you can get a sense of the return that they're going to credit to a whole life policy and dividends, or to a universal life policy based on what they're able to do with the money themselves. Or you can request this from the insurance companies or from one of these financial strength rating bureaus like AM Best, Fitch, Moody's, Standard & Poor's, is you can see how the insurance company is investing their money. So you can get a sense of what return they're going to be able to pay out, because they have to pay out less than they're making on their own money. So then you move to the different products. So you move to universal life insurance, where the company is paying out an interest rate, again, which is declared by the insurance company. It's same with the dividends. It's not tied into any measure or any external measure. Of course, the insurance companies have investment committees where they're deciding what dividend rate to pay out or what interest rate to pay out on a universal life policy. But from the outside, as an agent or as a policy owner, you don't know what that rate is going to be. And then when you get into the index funds and mutual fund accounts, so the mutual fund accounts will track certain mutual fund sub-accounts. Something to keep in mind is, even though your client may be invested in a Vanguard 500 index fund, and this is not an endorsement for a Vanguard 500 index fund, I'm using that as an example. The sub-account on the variable policy is not the same as the Vanguard 500 mutual fund that the client would buy from Schwab or whatever. And then on the index accounts, the indexes are tracking whatever indexes the company has available. It might be the S&P 500. it might be a NASDAQ account, it may be international bond fund. So you have all those different things to keep track of is, okay, how is the money being credited and what is it based upon? And you have to keep those things in mind for your client in terms of, is your client even comfortable with this type of policy or this type of arrangement? Do they understand it? That's where I've seen a lot of agents get into trouble over the years. I've done some litigation consulting. I did some work with the California Department of Insurance, and it's where agents sold things to their clients and their clients didn't really understand what they were buying. And that leads to a lot of problems down the road. So make sure you understand the product that you're selling, but you also have to really make sure that your client understands the policy that they're buying, and you have to check in with them to make sure they continue to understand how it works.
Yeah, I mean, a lot of great follow-up directions from that. I think the first and biggest one, though, that I had was if you have these variable insurance policies and they are investing into things like the Vanguard 500 index fund, but it's not exactly the same, what's different about it usually?
Usually they're pretty close, but the reason they're not the same is because they are a separate account. And the money managers can't always exactly match the investments at the price they make in both accounts. So that's the only reason I bring it up is because clients may say, this one isn't doing exactly the same as this one, and it's because they're not the same account. And it's
Sure.
really for that reason. It's timing, it's a pricing, um, but it's also
Well,
the expenses.
the expenses from the insurance policy, right?
Exactly. So, if you're buying this account directly as a mutual fund outside of an insurance policy, there's going to be a certain exchange expense charge on that mutual fund account. Now, if you're buying it as a sub account on a life insurance policy, the expense charge is usually going to be higher because you have an additional layer of management because you have the insurance company involved as well as the mutual fund manager. So that's another thing when you start talking about using life insurance as an investment. It's not an investment, it's an insurance policy that has a cash accumulation feature and investment feature. So that's something really important for new agents to consider.
Yeah, well, and it makes me wonder, like, why wouldn't you just get a whole life insurance policy and then invest your money in the Vanguard Index 500 fund separately? What are the advantages of getting a variable insurance policy instead?
In certain circumstances, let's say you do need life insurance for the rest of your life, then that justifies the additional cost of insurance. Because let's say you're buying a 20-year term life insurance policy, the company is going to say, okay, we're going to charge you a level premium, but we know that you're only getting it for 20 years. Now, if you're healthy enough to get a 20-year term policy, the insurance company knows pretty much for sure that your odds of dying in the next 20 years are going to be like less than 1%, maybe 2%. So the insurance company knows. So, and you'll see as an agent, when you get premiums for term life insurance policy so let's say you have a client who's 30 years old applying for $1 million of life insurance, the premium might be $500 a year. Well, there's a reason why it's that cheap is because the insurance company is pretty much for sure knowing that for that 30-year-old, they're not going to have to pay a death benefit in the next 20 years. The second part of that question is, so when you're looking at, let's say, a whole life insurance policy that's going to go to age 100, the insurance company is saying, okay, there's a pretty good chance that that person is going to die before age 100. It's not a 100% chance, but we'll call it a 95% chance. So the insurance company knows that they're pretty much going to be looking at a death claim. So they have to make sure that they're allocating enough money to pay those claims. Where on a term policy, they're pretty sure that they're not going to be paying a death benefit. Now you throw in a cash value, and the insurance company is okay. If a client lapses a term policy, they terminate a term policy and they walk away, the client gets nothing. So the insurance company is cool. We're fine, nothing happens. But if you have a cash value life insurance policy, the insurance company is going to have to pay out a death claim or they're going to have to pay out the cash surrender value. So the insurance company from there is also saying, hey, we are definitely going to have to pay out something. So, and since there's no free lunch, the insurance company is pricing that in and saying, okay, we're going to have to do that. Now, to get to your question of why somebody would want to do that, is there are certain circumstances where people have funded all their investment accounts, their retirement accounts, their IRAs, they have some extra cash, they decide that they want to do that. For me, that's one of the few reasons why people should be looking at some of these other life insurance plans. The other reason can be sometimes if they have a business and they're not able to have a 401k plan, is you do run into some certain circumstances where it does become appropriate to get into an index life insurance policy or a variable life policy. But for me, most of the time, there's not really a good reason to, unless you have somebody who has more money, they're more sophisticated, and they understand that it's a diversification tool for their overall portfolio.
Yeah, well, and I think that it's just important to understand these things from the customer perspective when you're going into being an agent for it. Similarly, I think another thing that's important for agents to understand is the underwriting process, right? You don't have to be an underwriter, but you always have to know the high level how it works. So, can you walk us through kind of what goes on in an underwriting process?
Yeah, and that's an excellent question. Long ago, when I first started in the business, life insurance agents were also called field underwriters. And what that meant, we weren't underwriters by any means of the word, but we were the first person assessing the client. And that's what the underwriting process is, whether it's life insurance, health insurance, auto insurance, whatever, is the insurance company is deciding whether or not it's a good risk, whether it's a risk they want to take on, and then what price they need to pay for that risk. So remember, like we've talked about, is the insurance companies have to pay the claim. So they have to charge the right premium to pay the claim. So one thing to keep in mind is that different insurance companies are going to treat different conditions differently because they each have their own way of underwriting a specific thing. So there's three general things that the insurance companies are going to be taking a look at. They're going to be looking at your age, more than three things. Your gender has a big impact because men live a lot less longer than women. Women outlive men by 7 to 8 years. So for women, life insurance is a lot cheaper. They're going to be taking a look at your health and they're going to be taking a look at your lifestyle. Now, when I say lifestyle, those are things like hazardous occupations, hazardous avocations. So let's say you like to helicopter ski. The insurance company is going to say that's a little bit riskier than somebody who doesn't jump out of helicopters and go skiing. For somebody who's more risky, the insurance company is going to charge a higher premium. So they're going to be assessing that. If you're a NASCAR race car driver, insurance companies are going to say, okay, you're pretty risky. So, we're going to have to charge you an appropriate premium for that. So that's what the way the underwriting process works. Now, where you can really make a difference for your client are with health conditions, is because health conditions can really vary. Even if you have something like breast cancer, which is a great example, your client has a history of breast cancer. Breast cancer can be all over the board in terms of the offers that insurance companies will make on it and the number of years before they'll make an offer. So the insurance company is going to, with their underwriting, decide, okay, do we think this person is a risk? How much do we want to charge them to take on this risk? So for a life insurance agent, some of the companies will have multiple underwriting classifications. They'll have two or three non-smoker rate classes. They'll have a couple smoker rate classes. And then you get into what's called a table rating, which is an additional premium that the company will charge if they feel the client is riskier. They might charge a flat extra, which is a flat extra amount of premium per year if they think the client is a higher risk. So you have to assess all those things. So you have to first, and this is the biggest mistake one big mistake I've seen agents do over the years, is to not talk to their clients about their health until they submit an application. My approach was to always talk about their clients before I even provided them a quote. That way I could provide them the most accurate quote, because you see these TV commercials and it's get $1 million of life insurance for $5 a month. And you're like, that's great. But they don't tell you that 1% of the population will actually qualify for that rate. So what you're doing, what I would recommend to any new agent is to pre-qualify your prospects by asking them health questions and then checking with the insurance company to see if any of these are an issue. Now, after you do this for a month or two, you're going to start to get a sense of what's going to be an issue or not. But those are things to think about is, okay, if my client is riskier, then the insurance company is going to charge more. And that is a really hard thing to do as a new agent is you get a quote from the insurance company and the quote is, let's say, $500 a year. You send in the application to the company, and the company's, whoa, wait a minute, this person is really risky. We can't offer them a policy for $500 a year. It's going to be $2,000 a year. That is a really hard lift to go back to your client and say, gee, your premium's gone up 4 times. Do you still want the policy? It doesn't work out that well. So you have to understand that the underwriting process is how the insurance company assesses a risk, and they're doing it because they have to remain profitable because insurance companies have to remain in business to be able to pay out the claims. So when they're doing underwriting, it's nothing personal to the agents or to the clients. The insurance companies are just trying to manage their risk.
Right. Well, and it goes through a complex formula. It's not really about you specifically. Let's talk a little bit about also just like policy writers. I think that's probably a good one to just go over real quick.
Yeah. So policy writers, there's lots of different policy writers. However, there's catch-all categories for policy writers. The one that people may have heard of is accidental death and dismemberment, and that pays an extra benefit if somebody dies from an accidental death. So let's say the basic policy benefit is $100,000. Your client has an accidental death benefit of $100,000. The beneficiary receives $200,000 if they die from an accidental death. So a rider is an additional part of the contract. So usually most riders the client has to pay for. There are some riders that the insurance companies offer for free, but the majority of riders your clients are going to have to pay for. So it's really important to understand what the riders are, what their purpose is, and do they benefit the client? Because again, you don't want your client to get into a rider where they're like, this isn't very good. Now, another common rider is called a waiver of premium on a whole life and term life insurance policy. And what that means is that the premium is waived if the client has a permanent and total disability. So that can come in handy because people do get disabled. It's not a very high portion of the population, but if it does happen, then your client's life insurance policy premiums are fully paid up. And this is where it gets tricky because on a universal life, index universal life, variable universal life, it's a waiver of cost of insurance. So what that means is on a whole life insurance policy, it's paying the whole premium. So your client's still accumulating cash value. You have that same equivalent rider, waiver of cost of insurance. It's not actually an equivalent rider. It's just going to pay for the cost of insurance. So there's not going to be any cash accumulation paid for under that rider on a universal life or index universal life policy. So that's where it starts to get into that you do need to understand what the riders are and what benefits. There's a lot of riders that are tied into terminal illnesses, chronic illnesses, different things, critical illnesses that you can put onto the policies. Some policies feature a rider where you can throw on a spouse or you can provide insurance for children. Let's say you're looking at a spouse rider. It might be better to get that spouse a separate life insurance policy. It might be cheaper, it might provide more coverage. So that's where it gets into that you have to take a look at this. And as I've said through this whole conversation, is you have to understand how each of these things work. And once you understand how they work, then you can find the right tool for your clients. And that's how you get
Yep.
referrals.
Right, exactly, which is really kind of the main thing that propels business or differentiates you from other people. Well, great. Let's talk a little bit about just like some things that new agents can do that helps explain life insurance to clients, right? I mean, you've talked a lot about understanding what the client needs, right? And matching the right coverage to it. So I think that's very important. But are there other things that they could do to help clients make the best decision for them and also avoid, a potential lawsuit down the road?
Have a conversation with your client and then listen. Take careful notes. If you don't understand something, if you have a mentor, if you have a general agent, depending on how your organization works, is talk to somebody about it. If you're not sure how something feels, don't push your clients into something that they're not comfortable with. Remember, think about it this way is usually with a lot of insurance companies, you're probably going to hear, tell all your friends you're in life insurance, sell all your friends a life insurance policy. That's how pretty much everybody starts in the life insurance business. Think about it. These are your friends and family. So it's a good opportunity to help them out if they need life insurance, but it's also an opportunity to really have open and honest conversations with them and ask them, do you understand what I'm talking about? Do you have questions? Do you have feedback for me? It's a good chance for you to practice because being able to listen and really understand what your client asks for is what will keep you from having challenges down the road and not forcing your clients into something that they don't really want. Is you're taught to sell, but really to me, sales is all about making the client happy and finding them what they need. So think about your experiences going in to buy something and how you felt coming out. So as you've probably heard, coming into the life insurance industry, a lot of life insurance agents have a really bad reputation. And a reputation is built on years of people selling products to people that they don't really want or need. So if you change that conversation to make sure that you're helping people get what they need and you're being an advisor to them, then you're going to have a very successful career and avoid a lot of these problems.
Yeah. Well, and I think there's also like the ethics part of it too, right? At the end of the day, you should be trying to act ethically and not just make as much commission as possible.
Exactly, because remember, are you in this as a career or are you just doing this as a sprint for 2 weeks? For most of us, this is a career. So if you're doing this as a career, you want to think about that long term. And the best thing I heard on this, it's not necessarily ethics, but I was at $1 million roundtable convention. I was probably 3 or 4 years into the business. So I was really new in the business. And I heard this lawyer say, he goes, if you're not sure about something, think about it this way. He goes, think about your 5 year old daughter looking over your shoulder during the sales process, and your 5 year old daughter going, Dad, why did you make this recommendation? And he said that, and I've used that. It stuck with me because I'm still saying this 30 plus years later. That stuck with me is to really, that, yeah, you have to stay within laws, churning, twisting, rebating, all things you're going to learn about. But some of these things fall into an ethical gray area. So you have to think about it like, okay, is this something that I could really explain and feel comfortable to somebody else about? Because sometimes in the heat of the moment, you might say, I really need to close this sale. You might feel pressure either from your sales manager, you might feel pressure because you have a rent payment coming up, but you have to think about this. Is it something that's really you are comfortable with and that you want somebody else to have to live with down the road?
Right. Yeah, and like you said, I mean, reputations take years to build and moments to destroy, right? So it's just really important to really focus on that. Well, great. What are your closing thoughts? Maybe there's something we missed.
You know what I'd like to talk about, what I wish every insurance agent knew was this really is a great business and we make a really positive difference in people's lives when we sell them the right products that they need. Everybody has certain risks in their financial lives. And sometimes, if you get blinded by selling that big whole life insurance policy, so you can get that nice, juicy commission, that's great, but it works once. However, if you build a relationship with a client, you sell them a life insurance policy, they have a job, they're making an income. You can work with them to purchase a disability insurance policy. You develop a relationship with them. They may purchase more disability insurance. They'll purchase another life insurance policy from you. They'll refer you to some of their friends. They might buy a long-term care insurance policy. They might buy a critical illness insurance policy. So you have to remember that this is really the top life insurance producers are usually people who are focused on building relationships rather than selling products. If you're building your relationships, you're going to be able to help people find the life insurance products that they need. And again, you're not selling, you're helping people. And that's the thing that I hope everybody takes away from this conversation.
Yeah, fantastic. Thank you so much. This has been Tyler from the Achievable FINRA and Insurance podcast with Tony Steuer. You can try Achievable's FINRA and insurance licensing courses for free by going to achievable.me. And if you like it, use the code podcast to get 10% off.